Well, hello there, challengees, and welcome to the Always Better Challenge Show, the show designed to help you take steps today that lead to a better and happier tomorrow. I'm your humble host, Joe Bedford. Before we get started, I'd like to ask three favors. First of all, please consider subscribing to the show if you have not done so already. Second of all, please consider signing up for our free motivational daily emails. You can do that at our website, which is abetterchallenge.com. And third, if you're a podcast listener, please consider rating and reviewing the show. Please give us a good, honest review. Let us know what you like and anything that we can improve. Now, as always, we're going to start off today's show with a quote/topic introduction. And today's quote is credited most commonly to Albert Einstein. However, there is some question about whether or not he actually said this. But I like the quote, and it fits in very well with today's topic, so I'm going to go ahead and present it regardless of who said it or if anybody said it. The quote is, "Compounding interest is the most powerful force in the universe." Obviously, you can see that why that's kind of cool if Albert Einstein did say it, but anyway. So yes, we are going to talk today about the topic of savings and investments. And first of all, I have to do the very important disclaimer that I am not a financial advisor. Therefore, I am not presenting, no part of the content of today's show should be considered financial or investment advice. I am providing you with information and ideas only. So with that being said, this is a topic I'm quite passionate about and excited about. I actually had a very nice conversation with my dear wife before filming today's episode. You could even call it a debate, perhaps. And keep in mind, my wife is a certified public accountant, so we had a really good discussion on this topic. And you know, she was sort of playing devil's advocate for some of my ideas, and it was really great. But it really made me realize that this is a subject that I have some pretty passionate opinions on, as you'll see it as we get into it. But the thing about savings and investment is, you know, this is the payoff. This is the payoff for living below your means, which is something that I've definitely preached in previous shows, and eliminating the consumer debt, you know, getting rid of the credit card debt. You know, I'm not even a fan of auto loans because, again, I could talk about this a lot. Auto loans I'm not a fan of. I'm not a fan of spending tons of money on cars in the first place because a car is a depreciating asset. So the thing with our consumer debt, our credit card debt, our auto loans, and, you know, like I say, even spending a lot of money on things like cars that are depreciating assets, this is where our money is working against us as a way of putting it. In other words, you know, we're paying interest on that credit card debt and on those auto loans, and so, you know, that's money that's coming out each month. You know, so it's almost like the anchor bringing us down. Whereas savings and investing is the opposite of that. First of all, if we've eliminated the consumer debt, we no longer have that money going out and weighing us down, but now we're actually using our money to make more money. I mean, that's an amazing thing. And another reason why I really liked that quote at the beginning of the episode was this was one of those turning points for me as a young adult in my early 20s, I believe, was the first time I was ever exposed to this. I need to try and find an example, and I'll do that and try and link this up in the show notes because this is more in-depth than I would be able to get into, I think, on today's show. But a chart that really shows you the magic of compound interest over time. I'll never forget when I saw this in my 20s, you know, because I had some experience with interest. You know, I think, you know, mom or grandma or somebody, you know, I had a savings account and it had, you know, hardly any money in it. And I made, you know, a penny or a nickel or whatever it was I made. And I hadn't yet made the connection that was of any great benefit. And then I saw a chart that showed how compound interest could work over time. And just sort of to sum up this concept, it's an exponential thing where you put the money in and then you get paid interest on the money you put in. But the compounding thing is then you continue to get interest on the money you put in, but then you also get interest on the interest and interest on the interest and interest on the interest. It compounds over time, so it's exponential. It doesn't go up like a straight line. It goes up like an exponential line that gets steeper and steeper as it goes, and that's where the magic is. This is maybe not the best example, but I think it helps illustrate this point, is the idea of doubling a penny every day for 30 days. And that's one of those little riddles or whatever. You ask somebody, would you rather I gave you $1 million, or would you rather I gave you a penny and doubled the penny every day for 30 days? And again, I didn't do the math before the show, but I'll maybe try and link something up in the show notes that shows that the doubling actually comes out first. And it doesn't look like that for a long time, because it's penny, 2 cents, 4 cents. It's not happening. But as it climbs the exponential curve, all of a sudden it starts happening really fast. And so that's sort of the same idea behind compound interest, where it's exponential. And so that's really interesting. And like I said, that was very eye-opening to me the first time I was exposed to that as a young adult. So we want our money working for us instead of working against us. Now here is a point that I'm going to bring up, and like I say, this is one of the things I guess I almost didn't realize I was so passionate about until I started discussing it with my wife. But yes, you can use a professional, but there are drawbacks. It's like I think probably that too many people, when it comes to their money, and especially in investing, especially if you've got like a 401k at work, which I imagine is the most common way that most folks invest, I worry that too many people are taking a head in the sand approach. They're like, I don't understand this, and it's complicated, and these people who are going to do it for me, they know what they're doing, so I'm just going to let them do it, and I'm not going to worry about it. And I worry that that's not the best way to go. That's definitely not the route I've taken, and I'm aware that this may be a hard sell, where I'm trying to, where people are just like, well, I don't want to take the time, and it is too complicated, and I don't know anything about it. But the thing is, I hope, if nothing else, I hope that today's show, I'm going to present some of the basic concepts to you, and I hope I'm going to demystify these and show you that the basics are not complicated. They're really not. And I really think that most anyone who wants to can do a lot of this, if not all of this, for themselves. And I really encourage you, if nothing else, if I just encourage you to learn a little bit more, and to not take the head in the sand approach, and to not just trust that these experts are always working in your best interest. So I want to make that point. The other point I want to make is that professional financial advice does not come free. And when you pay a financial advisor or planner or stockbroker or whoever you're paying, fund manager, not only are you losing out on that money, but keep in mind, we're in the phase now where we've got our money working for us. So not only are you losing out on the money that you're paying, you're losing out on the money that you could have made on the money you're paying. You see what I'm saying? You're losing out on that return as well. Again, if I can find something online I might link this up below, that shows how much better your investment actually needs to perform to offset an amount that you're paying in fees. So if you can avoid, can't avoid, but minimize your fees in the first place, that is going to make it a lot easier to have a good investment return. If you do choose to use a paid financial planner of some sort, I definitely can't stress enough that you want to use a fee-based planner. This means that you are going to pay someone a set dollar amount for their services. because what you don't want to do is to hire a planner who is getting paid based on recommendations that they're making to you. In other words, they get paid, they recommend that you invest your money in this fund, and that fund is how they're getting paid. Because, first of all, there's an obvious bias there. You want somebody that's working in your best interest in them. So a fee-based planner is definitely the way to go if you go down that route. Just another random point, and I'm sort of just going over some points here before I get into the nuts and bolts of this. When we get into the investing part of this, we are going to be mostly talking about stocks and bonds. Some folks are going to want to say, well, what about real estate investing? There's a couple of points I want to make about that. First of all, I've looked into it. There was actually a point where I was quite interested in real estate investing. And I know the real estate investors are going to disagree with this, of course, but I couldn't really see a huge benefit or advantage, or that investing in real estate was so much better than investing in stocks and bonds. Couldn't see a huge benefit there. And the huge drawback, obviously, is it's a lot more labor intensive. It's a lot more hands-on. You're going to have a lot more skin in the game. So I'm not recommending against real estate investing, but I think it's probably not right for everyone, because it definitely is more hands-on, and you're going to have to get your hands dirty, and I don't think that's for everyone. Another point about real estate investing that I want to make is I want to sort of dispel the idea of that buying a house is an investment. I mean, it's not that I'm trying to say it's not, but I just want to remind you that, yeah, you put your money, you pay off your mortgage, you buy your house, you own your house, it's an asset, but you need a place to live. So it's never going to be like your stock and bond investments. Those are some of the least liquid investments you have. Well, your house I would argue is even less liquid than that, because you need a place to live. So yeah, you could always downsize and pull some of the the equity out that way, but I just don't like to think of your home as so much as part of your investments. Your home is your home. So I just want to sort of put that idea out there before we move on. So now let's start to get into the nuts and bolts of savings and investing. So the first idea I want to present is the idea of having tiers or buckets. A lot of people use the analogy of buckets. So you've got, and I'm trying to think of how to say this. I'm sort of picturing like a pyramid, but I don't know if that's the best analogy. So let's skip that. Let's just go into our buckets. So our first bucket is going to be where we want to put money that we're going to need for short-term goals. So this is money that we might need within the next 5 years or less. So the money in this bucket needs to be very liquid. In other words, this needs to be money that we can access quite quickly if we need to. And this also needs to be money that is not subject to a lot of volatility, not a lot of up and down. And I don't know if this is the best time to mention this or not, but this is definitely a point that I wanted to make, and I guess now is a good a time as any. A lot of people talk about risk with your investments, and maybe I'm just playing word games or semantics here, but I don't so much like the idea of referring to it as risk. I prefer the word volatility, because I think that is a more accurate description of what we're talking about here with our investments. The idea is that high risk, if you want to use that word, but really it's high volatility, those are investments that are subject to a lot of up and down swings, okay? I guess the reason I don't like the word risk so much is we want to be investing in things that are going to go up over time. Why else would we be investing in them? We're not investing to lose money. We're investing to grow our money. So we want to invest in things that are going to go up over time. And the things that I'm going to talk about today go in that category. But yes, in the shorter term, there is going to be some up and down movement. Your balances are going to go up and down. The stock market goes up and down. Over time, it goes up. but there is some volatility. So I prefer that word, volatility, which is describing the up and down. So a low volatility investment is not going to go up and down much, but it's not going to go up as much either. That's the sort of risk-reward equation there. Your higher volatility investments, the swings are going to be greater, but the payoff that you get is that over time they do go up more. So good a time as any, I guess, to introduce that concept and to say, again, that I'm not a big fan of using the word risk. I just think that, I don't know, I just think that's a little, not the best description of what we're talking about here. So your first tier, you want that to be low volatility, and you want that to be very liquid. So what types of vehicles are we talking about here? Well, your checking account is a perfect example of this. And advice that I want to give before we move on in that regard is that you definitely want to have a checking account where you are not paying fees, and not only that, where you are receiving interest. Those accounts are out there. I have one myself. I'll probably link that below in the show notes. I'm not affiliated with that in any way, but there are plenty of options out there. I don't think in the year 2018 anybody needs to be paying fees or not receiving interest on your checking account. Now, you're not going to get much interest, especially nowadays. Interest rates are lower than they've been at some times in the past. You're not going to get much money, but why not get some? And certainly, why should you be paying money for a checking account when there are free options out there? So I'm a fan of that. So your checking account is definitely in tier 1, very liquid, and no volatility there really. Although, and again, maybe I'm jumping ahead a little bit here, you've got to keep in mind that your money that's sitting in your checking account, you are losing money over time because you're losing it to inflation. So that's a point to keep in mind. We may talk about that a little more later on. So you want an interest-bearing checking account. You can also have interest-bearing savings accounts in this tier, and those might pay a little more interest. Again, not much now. You can have money market funds in your first tier, your first bucket, if we want to call that the cash bucket, that might be a good name for that. Another option, and I'm not using this currently myself. Back when interest rates were higher, this made more sense, but I guess folks are still using this. You can also use certificates of deposit, CDs, in your tier 1. Do your research on that to make sure you're getting more return than you would get on a good high interest bearing savings account. And again, what are they paying now? You can get what, 1%, I guess, I think is maybe one of my, or maybe a little over 1%. I'm trying to think of my own savings accounts that I have. I think Sallie Mae, the school loan people, they have I guess they call it a savings account, or is it considered a money market account? I'm not sure off the top of my head, but I think that's the account that I have that pays the highest interest. Maybe it's 1.25%. I don't have any CDs right now. So are there CDs that pay more than that? Maybe a little. So you can look into that. And then you can ladder your CDs where they're coming due at intervals. So you don't have all your CD money locked up and you can't get it out for the whole length. You put a little bit in here and it matures here. You put in a little here, it matures a little later, put in a little here, and so forth. So that is another option for your first tier. Now, the next question obviously that comes up is, well, how much money should I have in that first tier? And it's up to you. The 6 to 12 months of living expenses is a figure that gets bandied around a lot, and I don't think that's a bad idea. Obviously 12 months is a little more conservative, 6 months would be a little more aggressive. But again, I want to revisit the point that I made earlier and drive this home. I don't want you to think, oh, well, I'm going to put 12 months in there because that's low risk. Well, it's low volatility, but again, you're losing money to inflation. And you're also losing the money that you could be making if you had that invested a little more aggressively. So there's different kinds of risk with everything. And I guess maybe that's one of the reasons why I liked using the word volatility instead of risk, because standing still, quote unquote, is a risk. So I want to make sure that you understand that. I'm considering this one bucket, but you can obviously have buckets within your bucket. So you could decide, okay, My checking account pays the lowest interest, but that's where I, use for my everyday, spending. So I want to keep whatever in there, $5,000, whatever the dollar amount is. So you can decide. I want to keep that amount in there. Then once I've got that funded, then the overflow can go maybe to my savings account, which pays a little bit higher interest rate. And it's still pretty liquid because you can, at least my savings account, I can transfer that right back over into my checking account anytime I want. But it's not, right in that account where I can write checks off it immediately. But it's still almost as liquid. But so you can do that. And then maybe you could decide, once the savings account has whatever dollar amount you set as the ceiling, then the overflow there will go into CDs or whatever, money market fund, whatever you decide. There's options there that you can use, and it's kind of up to you, Not complicated. And you might say, well, could I just leave it all in my checking account and keep it real simple? Yeah, sure. You're going to lose out maybe on a little bit of return that way, probably not a whole lot. Nothing wrong with that option if you want to keep it as simple as possible. So decide how much you want to put in there. 6 to 12 months of expenses, not bad. $5,000. That's a dollar amount that just popped into my head. That's obvious. I guess that's less than 6 to 12. I'm sort of thinking this through as I'm talking, and I apologize. And I just bumped the camera. I apologize. Y'all know I don't edit this show, so rarely. So your second tier, and this I gave a lot of thought to how I wanted to address this, because this is a little more tricky. What we're talking about here is this is money that you're not going to need for 5 years, between 5 and 10. So medium-term goals, I guess, is the way of looking at this. So this is not necessarily like retirement savings or something like that, but medium-term goals. So what do you want to do here? Well, again, you've got options. This is going to be less liquid. It's going to be more volatile. That's what we've talked about. So you could do a balanced mutual fund here, which is a mix of stocks and bonds. Or quite honestly, I wonder if all bonds might not be a bad way to go for this money. And maybe a mix of short-term and long-term bonds. And I guess I'm getting a little bit ahead of myself, and I'm going to get into this more when we start talking about stocks. If this all sounds complicated and you think, oh, I don't know anything about buying individual bonds and da-da-da-da, well, I'm not encouraging you to do that. I'm going to wait and talk about that when we get into stocks, but the same principles apply to bonds, which is we're going to be talking about index funds. So, excuse me, yeah, so your second bucket is going to be, as I say, these medium-term goals. And you want that to be, like I say, if it was all in bonds, that's probably not, I don't think that's an unsound plan. So your third bucket is going to be your long-term goals, money that you're not going to need for the next 10 years, so longer than 10 years. Obviously, retirement savings would go in this bucket. So these are going to, as I said, going to be your least liquid and most volatile investments. So, personally, I'm all stocks in this tier. And, I guess that's why I was saying for your second tier, if that's all bonds, that's okay. Because that's going to balance out, because your stocks, as I said, are going to be your most volatile investments, but those are going to be the ones that are going to pay the most rewards over time. So, as I said, this does not have to be complicated. I'm not suggesting you go out and buy, research and buy individual stocks and bonds, which would take a ton of time. What I'm suggesting that you do is, or what I do, I should say, so this is just an idea that I'm presenting, is I invest in low-cost index funds. The idea being, and this was one of the things that my wife and I debated about a little bit this morning. There are no money managers out there who are able to outperform the market in the long term. Now, in the short term, yeah, some of them may, but then guess what? They outperform for a while, and then they underperform for a while. I think it's, in my opinion, it's a loser's bet to try to beat the market. Just try to match it. That's That's plenty good enough, and you're gonna and that makes it simpler and easier. And this is why you don't, in my opinion, necessarily need an expert to help you. You can do this yourself by investing in index funds. So for your stocks, if you want to keep it real simple, you can just have one index fund for stocks that mimics. You can either choose to mimic the S&P 500, which is a pretty American-centric index, or you can do what I think I would encourage you to do, which is to mimic the total stock market. And there are funds that will do that. So basically, if the stock markets of the world go up, your portfolio goes up along with them. And I think that's the simplest, easiest, best way to do it. Yeah, and same thing with your bonds. You can buy again a single blended bond fund that combines short-term and long-term bonds, and you're done. You don't have to do all this extensive research. You're tying your boat to the market is a way to look at that, and that keeps it simple. And you're not going to underperform the market. You're not going to overperform the market. You're just going to ride along with it. And here is the overarching truth of the markets. Over time, they go up. Over time, they go up. I gotta show you this. I did this when I was talking with my wife this morning. I hope this shows up on the camera. This was like the most basic illustration I could give of volatility. So you've got this line here. The lines both start at the same place. You've got this line which ends up about halfway up the sheet of paper, and it goes up and down, but not a lot. So not a lot of volatility. Then you've got this second line which has a lot more volatility. The swings up and down are greater, but over time it goes up more. Over time, over the long term. Now in the short term, you're going to have the swings. So that's my idea, is that I want to be with the market. I know it's going to go up over time. I'm going to have my longer term money. I'm okay having that swing up and down because I don't care what it does swinging up and down here. I only care where it ends up when I need it. For my shorter term money, I don't want as much up and down swings because I'm going to need that sooner. For the money I might need tomorrow, I want almost, pretty much no up and down swings. I hope I've explained that in a good way. That's my stab at explaining that to you. So, and I also want to introduce the concept of dollar cost averaging, and this is where the 401ks are nice, where it just automatically comes out of your paycheck every time. This is how you want to invest in the stock market and in the bond market, is consistently in small amounts over time. Timing the market, again, I feel that this is a sucker's bet. You don't want to try to buy low and sell high because you're going to guess wrong. I mean, you're going to be wrong. So the dollar cost averaging, the beauty of this is that you are buying low and selling high, because what you're doing is you're putting in a consistent amount over time. So when stocks are more expensive, you're buying less because your money won't buy as much of them. When stocks are cheap, you're buying more because your same dollar amount here now will buy more of the stocks because they're on sale, is a way of looking at it. So dollar cost averaging, that's a great, easy, automatic way to buy low and sell high, quote unquote. So I'm definitely a fan of that. Now, I want to talk a little bit about the employer, the 401k that most folks have in their job, because like I say, I think that's how most folks probably do invest. And a lot of employers will offer a match. And so my first advice is, you want to take the most, advantage of that employer match as you can. That's free money, baby. So you definitely want to maximize that is a no-brainer in my opinion. And this is the case even if the investment options, and I'm going to talk a little bit about investment options in a moment, but even if the investment options in your employer 401k stink, because some of them do, I think hopefully they've gotten better over time, but they may stink. But it's hard to leave that free money on the table. So that's probably still something that you want to do. If you do a little research and realize that the options do stink, don't be afraid to be the person in the company who advocates for better options. I did that at one place that I worked, and as I recall, I was successful, if I remember correctly. I said, hey, we need an option like this, and I think they did present that option later on. Perhaps that might have been because of my feedback. Now, if the options do stink that your employer offers, take advantage of the match, but maybe you don't want to put any more in than above where you're going to get the match, and maybe you want an external account for the rest of your money. In that case, or if the case is that you've invested everything you can in the 401k and you still have more money you want to invest, you might want to examine a Roth IRA. Those are a great option to have outside of a retirement plan, because you invest in those with money that you've already paid taxes on, so your money grows tax-free. So another way of looking at that is you're paying the taxes on the money now while you're working and probably making more money, and it's going to grow tax-free, and then you're going to be able to enjoy that in your retirement years when you may have less money. So it might be better to pay those taxes now. Here's where I'm getting into investment options. You want to avoid loads like the plague. Front-end loads, back-end loads. A load is just another word for money out of your pocket, a fee that you're paying. And do they even have load fees anymore? I know that was a thing back in the day. I almost hope that people have gotten educated enough. There's no reason to pay these high expenses. As I said before, money that you're paying, not only are you losing the money you're paying, you're losing the money you could have made on that money. So, and that's the other beauty of the index funds that I mentioned above, is that these funds have low expenses because you're not paying some expert to research and buy and sell securities. They're basically just automatically investing in the market as a whole. So that you definitely want low expense funds, not these high load funds. That's a no-brainer. I'm not going to talk about this too much. This was some of the biggest debate that I had with my wife. I am not a fan of target date funds, funds that are geared towards your retirement date. And I know a lot of times that's the option in these employer 401ks, and it sounds like an easy option for folks, and I think they go for that. I'm not going to say they're the worst thing in the world, but you are giving up a lot of control. And I also feel like you're paying someone else to do asset allocation for you, and I feel like asset allocation is not that hard and something that most folks could do for themselves. What I'm talking about here when I talk about asset allocation is how much of your money to have in stocks, how much of your money to have in bonds, and how much of your money to have in cash. That's a very simplified version of asset allocation, and for most folks that's probably as deep as they need to get into it. Again, your cash being your first bucket, your low volatility, low return bucket, bonds being a medium volatility, medium return bucket, and stocks being a high volatility, high return bucket. I'm oversimplifying those, but that for our purposes today, I think that works. The time frames are what help us here. If you're about to retire, you maybe hardly any or none of your goals are in the 10 plus year bucket. So, you want to have less in stocks, more in bonds, more in cash. Keep in mind, though, you probably still want to have enough in stocks to, at least, keep pace with inflation, because that, as I said, there is no risk-free option here. If you're going for the lower volatility options, you're not getting the returns and you're losing money to inflation. So deciding how much money you want to have in each one of those buckets, that's what we're talking about with asset allocation. When you're younger, obviously it can be more weighted to stocks. As you get older, maybe you want it less weighted to stocks. Personally, at this point, and I'm 50, and I hesitated how much I wanted to talk about what I actually do myself, because it's maybe that thing of do what I say, not what I do. I've learned a little bit more about the about investing, and so my investments are a little more complicated, and I don't want to overcomplicate it for folks out there. If you're interested in that, you can dig into that and overcomplicate like I have. But I just want to present a nice, simple option for folks. But so mine are a little more complicated. Mine are a little more risky. I do have most of my money still in stocks, which, I'm 50, so some folks might say that's too much. I'm okay with that. I do have some in bonds, and I almost got tricked into that. It's because, it's a long story that I don't want to get into, but my wife has an IRA at work, and we don't want to leave the money on the table because there's an employer match. And so I've decided, okay, we'll put that money in bonds. That's a nice way to offset the riskier stock portfolio I have. And since we have to put money into it because we don't want to miss out on the employer match. So that's what I'm doing. So I've got a lot in stocks, I've got some in bonds, and some in cash. So that's me. I get real quick, I want to talk about ETFs, which are exchange traded funds. I only mention those because there seems to be a lot of talk about those these days. That's almost like a trend or a fad. I hate to use that word, but I looked into these. I'm not saying there's anything wrong with them, but I just couldn't see a real compelling reason to get involved in them, so I didn't. The benefits that are mentioned for them, I just didn't seem like benefits that applied to me. Seems like they're easier to trade, or you have more price transparency with trading, but I don't think you should be trading anyway much. So that wasn't compelling to me. And that's probably a good point that I didn't make, and I didn't have in my notes that I do want to make. With your savings and your investing, you want this to be as much set it and forget it as you can. Like I say, your stocks, that's 10 plus years money. You're not going to need that money. As I say, not as I do. I do monitor what my stocks are doing, but for most folks, I almost think you shouldn't, because it might freak you out if they're going up and down. You don't care if they go up and down as long as they're going up over time. And if it's in there long enough, you can do your research on this. It goes up over time if you give it enough time. So yeah, I'm not a fan of trading. Put it in there, leave it in there. Put the money in the stocks and leave it in there. Put the money in the bonds and leave it in there for the most part. Those are a little more medium-term goals, so some of that might come out. But don't, I'm even though I know a good bit about investing, I don't want you to think I'm a person that's constantly selling this and buying that and selling this and buying that. That's a good way to, not like I said, my goal is to match market performance. All that selling and trading, that's a good way to not do that. First of all, you're getting more into guessing and betting and trying to outperform the market, and I think you're not going to. And then the fees with the trading. So I'm not a fan of that. I'm a buy and hold investor. I'm a buy and hold investor, and I suggest that you be the same. So I guess that's it for today's show. This one, I'm over the 30 minutes, and I don't want to run too much longer, and I think that's enough. So my thoughts I want to leave you with are, first of all, I encourage you, don't put your head in the sand on this stuff. Don't be scared of this stuff. Don't be intimidated by this stuff. Don't be overwhelmed by this stuff. Don't think that first of all, don't think that somebody who's going to tell you what to do with your money necessarily has your best interest at heart. I'm saying that just up, out there like that. Nobody's going to care more about your money than you, and it does not have to be complicated. Cash, bond fund, stock fund. It does not have to be complicated. I encourage you to comment on this video. Questions, any of that. Please bring that up. Again, I do want to make sure that I make very clear with the disclaimer, I am not a financial professional. I am not providing financial advice. Do not construe any of this as financial advice. It is ideas and information. I hope you have found this information valuable. I look forward to hearing your comments. Please subscribe to the show if you've not done so already. Please consider signing up for our emails at abetterchallenge.com. And please rate and review the podcast if you are a podcast listener. I think that wraps it up for this time. Just our quick summary. Buckets. I've summed that up. I'm trying to do a better job of doing what I mentioned in a previous episode of telling you what I'm going to tell it to you, and then tell you what I told you. Don't be afraid of it. Set up your buckets. figure out your percentages. It does not have to be complicated. So that's it. Thank you, as always, so much for watching or listening to the Always Better Challenge show. Until next time, I'm your humble host, Joe Bedford, reminding you to go out there and make it happen.